You have probably heard all four terms as if they were four competing investments, but they do not all describe the same thing. One describes a strategy, two describe how a fund is structured and traded, one belongs to a very different world of private investing. Give me the next few minutes and you will understand how each works, what it costs, where the risk comes from, and who it is designed for. First, what is a fund? Imagine 5 friends pooling money for a party. Individually, one can buy the cake and another the drinks. Together, they can pay for the full meal. A fund works the same way. Money from many investors is pooled to buy assets such as stocks or bonds. Suppose you invest $100 in a fund holding Apple, Microsoft, banks, healthcare companies, and government bonds. You own a small share of that basket. The basket can spread risk, but diversification does not remove risk. If most assets inside fall, the fund can fall too. Now let us begin with an index fund. An index is a measuring list. The S&P 500, for example, tracks hundreds of large US companies. An index fund tries to copy a chosen index. If it tracks the S&P 500, it may hold many of the same companies in similar proportions. It is not trying to discover the next winning stock. It follows preset rules, that is passive management. Think of it like following a recipe exactly. The fund is reproducing the original, not inventing a better dish. But low cost does not mean low risk. Imagine an index containing only semiconductor companies. It may own 20 stocks, but all 20 could fall together when the chip industry suffers. An index fund is only as diversified and as risky as the index it follows. Now compare that with a mutual fund. A mutual fund is a pooled investment structure. Some follow an index, others are actively managed. In an actively managed mutual fund, a professional manager decides what to buy, hold, or sell. Suppose the manager expects healthcare stocks to outperform technology stocks. The fund may reduce technology holdings and buy more healthcare companies. That sounds attractive. An expert is managing the money, but here's the catch. Expertise costs money, and it does not guarantee better results. Funds can charge an expense ratio, an annual operating cost deducted from fund assets. If a fund charges 1%, that is about $100 a year for every $10,000 invested. A 0.10% fee is about $10. The percentage looks small. Over many years, the higher fee leaves less money invested and compounding. A traditional mutual fund normally trades using its net asset value, or NAV, calculated after the market closes. You might place an order at 11 in the morning, but the final price is determined later using the end-of-day NAV. Now we reach the idea that confuses almost everyone. Index fund versus mutual fund is not always a true either-or comparison. Why? Because index fund tells you how the money is managed. Mutual fund tells you how the investment is structured. A mutual fund can be an index fund, and an index fund can also be an ETF. Think of index as the recipe, and mutual fund or ETF as the container. Two funds may both track the S&P 500. One may be a mutual fund priced after the market closes. The other may be an ETF trading throughout the day. The strategy is similar. The buying experience is different. So, what exactly is an ETF? ETF stands for Exchange Traded Fund. Like a mutual fund, it can hold a basket of assets. It may track an index, or it may be actively managed. The key difference is how investors buy and sell it. An ETF trades on an exchange during market hours, much like a stock. For example, an ETF trading at $50 in the morning might move to $51 or $49 later. You can choose when to place the order instead of waiting for one end-of-day price. That flexibility is useful, but it creates different details. An ETF's market price can be slightly above or below the value of the assets it owns. Investors may also face a bid-ask spread, the difference between what buyers offer and sellers demand. So ETF does not automatically mean cheaper, safer, or better. A broad market ETF may be simple and inexpensive. A leveraged or narrow sector ETF can behave very differently. An ETF holding the total market is not the same as one designed to produce twice the daily movement of one sector. Now the structure changes completely. Hedge funds. The name sounds protective, as if the purpose is always to reduce risk. In reality, hedge funds may use short selling, derivatives, concentrated positions, and leverage borrowed exposure that can magnify gains and losses. Imagine a fund has $100 million from investors but creates $200 million of market exposure through borrowing or derivatives. A 10% move in the right direction may amplify gains. A 10% move in the wrong direction may amplify losses. Hedge funds are private funds, commonly aimed at institutions and investors who meet eligibility requirements. They may require large minimum investments and restrict withdrawals. For example, an investor may be allowed to withdraw only quarterly or after a lockup period. Why would anyone accept that? Because hedge funds may try to make money in ways not limited to buying the market and waiting for it to rise. A hedge fund might buy a company it believes is undervalued and short another it believes is overpriced. Others may trade currencies, commodities, or interest rates. But complexity makes risk harder to see. Leverage can amplify a correct decision. It can also amplify a mistake. Limited liquidity may stop you from exiting when you want. So let us place all four ideas on the same map. Following an index with preset rules describes an index strategy. Trading through a fund at end-of-day NAV is commonly a mutual fund structure. Trading shares throughout the day on an exchange is an ETF structure. A private fund using flexible and potentially complex strategies for eligible investors is a hedge fund. And notice the overlap. An index fund may be a mutual fund or an ETF. A mutual fund or ETF may also be actively managed. A hedge fund is not simply an advanced ETF. It serves a different market with different access, liquidity, fees, and risk. So which one is meant for whom? Imagine 4 investors. The first invests automatically every month and does not care about intraday prices. A broad, low-cost index mutual fund may suit that approach. The second wants similar broad market exposure, but prefers exchange trading. A broad index ETF may fit better. The third wants a professional manager and accepts higher fees and possible underperformance. An actively managed mutual fund may appeal to that person. The fourth understands leverage, restricted withdrawals, complex strategies, and substantial losses and meets the eligibility requirements. A hedge fund is designed more for that investor. The simplest way to remember everything is this: do not judge a fund by its label. Ask what it owns, how it is managed, how it trades, what it costs, and how much risk and restriction you are accepting. These may sound like 4 competing products, but once you separate strategy, structure, access, fees, and risk, the confusion disappears. The goal is not to memorize 4 definitions. It is to know the right questions before your money enters the fund.